please press star 1 on your telephone keypad. I will now hand you over to Mohammed Faisal Portrick from Riyad Capital to begin. Please go ahead.
Thank you very much. Good afternoon and good morning, ladies and gentlemen. Riyad Capital is pleased to host the management of Riyad Bank for the third quarter earnings call. I will hand over the call to Mr. Rayyan Al-Shoaibi, Head of Investor Relations at the bank. Please go ahead, Rayyan.
Thank you, Patrick. Good day, everyone, and thank you for joining the call. With us on the call today, our CEO, Nader Kraya, and CFO, Abdullah Araini. As always, CEO will start with the financial highlight and strategy update, followed by the CFO to cover the financial performance in more details. Then we'll open the floor for your questions. I would like to remind everyone that today's presentation is available on our website. With that, I'll hand over to CEO to start the presentation. Nader.
Thank you, Rayyan. Good afternoon and good morning, everyone. And thank you for joining us today for the third quarter 2025 earnings call. I'm pleased to be here to share the highlights of another strong quarter and the continued momentum we have seen throughout the 9 months of the year. Today, I will walk you through our key financial results and update you on the progress we are making towards our strategic goals. The quarter performance reflects our management team's strong focus and the outstanding dedication of our people across the bank. Our focus will continue to be on accelerating and completing our remaining strategic priorities, centered around 2 main themes: strengthening cross-sell efforts to unlock greater value across our businesses. Second, continuing to execute on high-impact efficiency initiatives by optimizing our cost base and raising operational efficiencies across the organization. We are all excited about the road ahead, and I look forward to sharing more details with you during the call. Let's now turn to the financial performance highlights for the 9 months of 2025. On the balance sheet side, we maintained strong momentum in the third quarter, with total assets reaching 508 billion Saudi riyal. That represents 13% growth year to date. This growth was mainly driven by a 48 billion Saudi riyal increase in our loan book, which represents 15% increase year to date. On the funding side, customer deposit grew 6% year to date, and we continue to diversify our funding sources, including wholesale and interbank funding, leading to a total liabilities rising 14% year to date. With the solid balance sheet performance in place, let's look at how this translated into strong earnings and profitability during the period. So, backed by strong asset growth and cross-sell activities, we delivered a 9% year-on-year increase in operating income. That's also been supported by a 2% rise in funded income and an impressive 27% growth in fee income. Our focus on cost and operational efficiencies is delivering results. Our cost-to-income ratio improved to 29.7%. That's down 100 basis points from the same period last year. So, as a result, our net income reached 7.8 billion Saudi riyal, which is up 10% year-on-year, with ROE improving to 17.2%. That's an increase of 24 basis points from last year. Our asset quality remains strong. NPLs are lower by 32 basis points compared to the same period last year, reaching to 0.87%. And our coverage ratio improved to 142%. This reflects our disciplined risk management approach. Also, our capital position remained healthy, with a total CAR of 17.8%, and liquidity remains solid, with SAMA-weighted LDR of 84.1%, all well within regulatory limits and ratios. Before we move to the strategy update section, it's worth to highlight a couple of points on the market liquidity and funding. So, although the system regulatory LDR continue to be healthy and well below regulatory limits of 80.4%, as of September 2025, the system loan growth of 14.3% year-on-year continues to outpace the deposit growth of 7.9% year-on-year, which puts some pressure on the liquidity in the system, and we have seen that during the year, and as a result, a pressure on cost of funding. However, we anticipated that the pressure on liquidity to ease off in the coming period, driven by the following. Usually in Q4, we witness a slower growth compared to previous quarters, as we expect repayments, which is actually a trend that we have seen in the previous year, driven by government payments cycle. Also, loan growth is expected to slow next year, to be around high single to low double digit, due to the new requirements of counter-cyclical buffers and the liquidity pressure, which will reduce the gap between loan growth versus the deposit growth. Also, lower interest rate, and we have seen already 2 rate cuts so far, and that's expected to ease off the pressure on cost of funding and will help in improving the liquidity in the market. In addition, banks in general are expected to continue to access the debt capital market to support liquidity. From our perspective in Riyad Bank, and as part of our continuous liquidity and capital planning, we took a number of forward-looking actions during the 9 months through tapping in different wholesale funding instruments, which will support the liquidity position and provide long-term benefits and alignment with our next 5-year strategy while managing the interest rate risk. Lastly, securitization of the mortgage portfolio will continue to be an option to support the liquidity and free up some of the capital to capture new opportunities. In slide 4, as you know, 2025 marks the final year of our current strategic plan, and I'm proud to report that all our key performance indicators are either ahead of or within target. You are all familiar with our strategic ambition, which is anchored on 4 core pillars. I will highlight the progress on some of the strategic KPIs against our base year 2022. So in the profitability side, with ROE standing at 17.2%, we delivered an ROE expansion of 270 basis points compared year-end 2022 of 14.5%. On efficiency, our efficiency has significantly improved, with our cost-to-income ratio reaching to 29.7%. That's an improvement of 274 basis points compared to 32.4% in 2022. This was also supported by improved process efficiencies across the bank, with time to cash enhanced for most of our products offerings. And when it comes to bank of choice, our customer satisfaction maintained strong momentum across all segments, supported by enhanced app features and targeted services and branch enhancements. This has also resulted in our brand value growing by 56% to reach $2.75 billion compared to $1.76 billion in 2022. Lastly, on the digital side, this is a very important pillar for us to ensure that we remain relevant in an evolving market dynamics. We have delivered and launched several initiatives to drive our innovation, digital offering, and customer experience. That's including the launch of our new mobile application, Center of Intelligence, and 1957 Ventures Company. Earlier this year, we began the process of shaping our next 5-year plan. We have successfully concluded the development of the Bank 2030 strategy with a clear ambition, as the bank will become a market leader in innovation. Our 2030 strategy will continue to build on the strong foundation we have established, with its key theme aligned to our long-term strategic objectives, centered around strong shareholder value creation, fostering customer and employees' experience, accelerating our digital initiatives, and be a trusted, resilient, and sustainable bank. We target to share further details of this strategy and update you on the new strategy early next year. With that, I will now hand over to my colleague Abdullah to walk you through the financial performance in more details. Abdullah.
Thank you, Nader. On slide number 6, I think that's a snapshot of the overall progress in terms of the balance sheet evolutions, as well as the key profitability and funding and capital metrics. I think the overall strong growth on profitability was boosted by a strong growth in operating income, as well as a continued improvement on efficiencies, as well as the credit risk cost, which was largely enhanced by our focused approach on recovery since the past 18 months. The balance sheet has expanded by 13% on a year-to-date basis, primarily driven by strong loan growth of 15% on year-to-date for the first 9 months. These were largely funded by customer deposits in the form of interest-bearing deposits, as well as market funding, in addition to marginally on the non-interest-bearing deposits. I think it is this year, over the course of the past 9 months, we have seen a change in the liability mix, as well as the NIPS shares coming down to 47%. And I think that was primarily on the growth of the IPs, as well as other components of the liability side. It's worth highlighting that the efficiencies journey continued to be an area of focus. If you recall that at the beginning of 2024, it was part of our strategic priorities is to increase efficiencies and productivity across the board. And I think this is very evident on the registered cost-income ratios for the 9 months to land at 29.7%. The expenses overall, or the cost base, has grown year on year by 5%. And that also has reflected the continued investments in infrastructure, as well as in the capabilities of the bank. Cost of risk has decreased from 51 basis point to 36 basis point year on year, while the NPL ratios has recorded 0.87% for the aforementioned period. That has resulted on a 10% year-on-year increase in our net income, and has increased our return on equity to reach 17.2%. While we witnessed a margin contractions on a sequential as well as on the 9 months basis, I think the net special commission income grew 2% year on year. Liquidity and funding measures continue to be at the comfortable level, while capitalizations continue to be as per our plan at the strong level. On slide number 7, I think, as I highlighted in the previous ones, the loans has been the primary component of the assets growth, where basically 49% or 49 billion has been recorded since the beginning of the year, while we continue and incrementally and opportunistically add to our investments book, while we continue to manage our short duration assets in the most optimal basis. The loans have been led by the corporate and SMEs primarily, and while mortgages and other retail have marginally increased over the past 9 months. The overall compositions has inched up a little bit to account for 72.5% in the form of overall corporate, while 27.5% are on the retail, including mortgages. I think the right-hand side of the slides gives you a flavor on the compositions of the loans and advances portfolio, while corporate and SMEs continue to account for the majority, followed by the corporate, and then followed by the mortgages, and then the non-retail segments. On slide number 8, I think Nader has highlighted and alluded to our continued focus and efforts on managing the balance sheet as part of our ALM framework, while continue to diversify the funding sources as well as the maturity profile of both the liabilities as well as the mismatch between the two sides of the balance sheet. I think the overall liquidity positions remains very strong. As you can see that the debt securities has increased by 23.6 billion over the course of the last 9 months, while deposits continue to increase at a slightly lower volume, but different growth rate. Interbank primarily are driven by our high quality reportable investment securities, will continue to benefit from an optimized funding basis on that one. The deposits movement on the lower left side charts highlight what I mentioned on the increases of the interest-bearing deposits, while over the past 9 months also we have witnessed some migrations of the non-interest-bearing deposits in the form to the basically interest-bearing deposits. Both net stable funding ratios as well as liquidity coverage ratios stood at very healthy levels, well above the regulatory minima as well as our internal risk appetite, while the SAMA LDR is well within limit, and the headline LDR has marginally increased Q-on-Q and by 8.8% on a year-to-date basis. On slide number 9, I think we're shedding some light on the net special commission income key movement. I think the key message here is that the increases in volume was largely offsetted by a continued increase in cost of funds, and the cost of funds increases, as you can see from the chart, has increased by 25%. I think on the back of one is the reasons that my colleague Nader has highlighted at the beginning of the call, and also the second part is that is the diversification as well as the liability mix change that we have prudently elected to build up to position the bank in a proper way to capture growth in the medium and long term while addressing key ALM metrics. I think the volume has increased in a way that has absorbed the majority of the cost of fund increases, while selectively also growing our investments portfolio, as I highlighted before. I think it's worth mentioning that on a year-to-year basis, that there has been a decrease on the average SAIBOR 3 months by almost 70 or 68 basis point. I think that has also filtered throughout the year on our yield, as you can see from the net special margin chart, and that has also partially offsetted in terms of the not only the asset yield but also the increments in the cost of fund has also decreased the margin accordingly. I think it's worth highlighting here is that the Q3 as well, in terms of the net and special commission income margin, has fully absorbed all the activities that we have done towards the end of Q2 as well as Q3 debt and loan capital market accessibility. On slide number 10, I think it is continued an area of focus. As you recall, also it was part of our strategic priorities that we have shared with you at the beginning of 2024, which were primarily on increasing revenue and cross-sell across the board. And the second is the efficiencies and productivity maximizations. I think it's evident that from our quarterly trend over the past 5 quarters that we continue to remain focused on driving the fee and other income upward. I think that has largely offset our margin decline, what we have witnessed on the past 3 quarters. And I think it's worth highlighting here to remind the investor community that we see that all transactions that we entered from a value perspective were both not only the spread, but also the ancillary business that associated with these deals are considered as a whole. And I think this is a record fee and other income for the bank, where it's recorded 1.5 billion. And it shows over the past 5 quarters that a CAGR of 21% or 21% from a similar quarter last year, which was a very strong quarter, again, as another record for the bank. In terms of the components of the fee income from banking services, I think credit facilities as well as the trade finance continue to be the key areas, which is reflections of our leadership and when it comes to the whole bank, the wholesale banking propositions, and being a leader on the trade finance bank overall. I think the lower right-hand side by chart is just to highlight the components of these key income. Putting it all together, I think before we jump to the expenses, I think it's worth highlighting that for the first 9 months, we have recorded 8.6% growth in our total operating revenue. And I did mention that 5% has been increased in terms of the cost base, and that leads us to 3.6% positive jaws, which is one of the strongest positive jaws that we have encountered on the recent quarter. While at the same time, we continue to invest in our digital and infrastructure when it comes to the technology, and we continue to invest on our people and also the strategic initiatives that will set us in a proper positions for the next strategic horizon next year onwards. It's worth highlighting that overall, I think the cost base is trending in the right directions and well within our plan. Cost to income ratio, we have discussed it before, but I think it's worth highlighting that this is one of the lowest cost income ratios that we have incurred on a year-to-date basis. On slide number 12, I did allude it at the beginning on the cost of risk, that the strong recoveries and our focused and with the special assets team prioritizing the key recoverability of certain exposures have resulted in a very strong recovery for the year. So on a year-on-year basis, this is 62% or another 284 million recovery that has been encountered, which has helped significantly the overall cost of risk reductions, as well as in terms of the amount, as well as in terms of the percentage point. NPL movement highlights that the commercial book continued to be at a very healthy level, while the consumer has encountered a marginal increase on a year-to-date basis. NPL ratios at 0.87% continue to be of a strong level, with an NPL coverage ratio of 141.7% for the 9 months. Staging continue to more or less be pretty much stable in terms of the ACL on gross loans coverage. Not only that, but also with the enhanced collaterals overall. On slide number 13, I think putting all these considerations and factors together, I think that has landed us to a 10% growth year on year. I think where positive jaws continue to be intact at a very meaningful level, while at the same time we continue to derive efficiencies as well as manage our cost of risk prudently. The overall income level for the bank in terms of revenue continue to be very healthy. The overall efficiencies are tracking as we expect them and slightly ahead of our plan. And that has resulted with a continued strong return on assets as well as return on equity. On slide number 14, to give you an overview on the capital supply as well as the capital consumptions, while we continue to increase our consumptions at a speed higher than the capital generations, taking into account as well the consistent dividend that we had also executed as an interim dividend this year. But I think it's worth highlighting that the risk-weighted assets also reflects our strong franchise of the trade finance, which has a significant component of the off-balance sheet as well. As you can see, capital ratios continue to be at a very healthy level. We continuously monitor and observe our all capital ratios, including the Common Equity Tier 1, which continue to be at a healthy level that supports our credit ratings with the major rating agencies. I think it's worth highlighting that the regulatory capital overall has continued to record strong growth. And I think a key highlight here is that, as you are very well aware, we had issued in July a Tier 2 of $1.25 billion equivalent of Tier 2 capital, and that has primarily replaced the Tier 2 stock of capital that we had called in Feb 2020 of $1.5 billion. Last but not least, I think the momentum on the strategic executions continue to be favorable and has been fueling the delivery of our key 2025 key performance indicators. The guidance towards the end of the year, we anticipate to conclude the year at the mid-teens, probably slightly ahead. It depends, or it's going to be as a function of the repayment cycle that my colleague Nader has mentioned at the beginning of the call, which would set us on a very strong positions in terms of future revenue generations capacity as well. The net special commission income, we have lowered our guidance towards the end of the year on a reflections of the recent development on the system as well as in the bank in terms of cost of fund, but also taking into considerations that the diversifications in terms of the funding and the capital resources that would support us on the future quarters, as well as the assets growth plans that we had already executed and partially to be executed. I think the cost income ratio, we are revising down our guidance that we had established at the beginning of the year with the accelerated efficiencies that we had been witnessed during the first 9 months, and we expect to end the year just below 30%. In terms of return on equity, I think two factors has been considered here. One is also we had an increased equity level compared to the previously anticipated of some valuations exercise of one of our investments on certain companies in the local market. But also more importantly is also a reflections of the margin or the low single digit guidance that we had revised. Cost of risk continue to be in the same area that we do expect. while at the same time, Tier 1 capital ratio is no change on the guidance. We do expect to land above 15%. With that, I will hand back to the operator for Q&A.
Thank you. We will now begin the Q&A session. If you would like to ask a question and you have joined the call via WebEx, then please press the raise hand icon on your screen. Alternatively, if you've joined us on the telephone, then please press star 1 on your telephone keypad. Our first question today comes from Naresh Bilandani from Jefferies. Please go ahead.
Yes, hi. Thank you very much. It's Naresh Bilandani from Jefferies. Hi, Nader. Hi, Abdullah. Nader, would you please be able to offer any color on what do you think could be the impact of the higher countercyclical capital buffer on the overall credit volume? You indicated during the presentation that it could have a slowing effect on the credit volume. So if you could please offer any broad indication in context of the current 14% pace of growth that is trending across the system, that would be extremely helpful. That's first. Second is, would you please be able to call out any specific factors that are leading to a consistent decline in the credit risk weight density, which has dropped from 96% 2 quarters ago to around 91% currently? It would be very helpful if you can guide, like, should we model a similar percentage in the future quarters too? And once again, please call out any specific areas that are leading to this decline in the credit risk weight density. Thank you so much.
Thank you very much. So for your first question, we'll definitely decelerate our lending growth if you compare it to 23, 24, and early 25. And this is, I think, giving, if you look at the banking industry in the kingdom, I think we are all going through the same trajectory here. However, as I said earlier, we do expect this funding or liquidity crunch will improve going forward, and we probably will see it end of this quarter and going forward. So we'll definitely reduce and decelerate our loan growth going forward, and we will continue improving our CAR ratio again through tapping into the local and international markets when it comes to sukuk issuance and bond issuance. Obviously, the interest rate cuts, as I mentioned, should help, and we will probably go like other banks and securitization of our mortgage portfolio. And for the second part, Abdullah?
Yes. The second part, I think the credit risk density has a multi-factor that has. First of all, I think we continue to look for every single venue of RWA optimizations across all risk types and risk registers. I think it's worth highlighting also some of the growth area has been on a relatively low credit RWA components, particularly in some large transactions that we have done. And I think this reflects very well in terms of the credit risk density. Also, I think we had taken some advantage of a certain transactions in the investment side. So I think that has overall helped. But at the same time, we continue to have above market off-balance sheet credit RWA, reflecting our leadership positions on the trade finance proposition. Do we model this going forward? I think this will continue to be an area of an opportunistically driven rather than a modeled approach. But I think there has been a great deal of focus in terms of where we can further optimize our capital consumptions component.
Understood. Thank you, Abdullah. Nadir, if I could please just have a follow-up on the answer that you provided to the earlier question. My question more was, do we see the current sort of like the 14% loan growth at the system level slow down meaningfully this point next year? Will it still stay into double digits, or do you reckon that the broad intention of the authorities is to improve the liquidity situation by rather slowing down the current pace of credit? So eventually it will lead more down into high single digits rather than staying in double digits, say, if we are speaking this point next year. Any color that you can provide there?
For me now, the main focus is improving all my ratios. Obviously, anything can happen next year. Oil prices could change, the liquidity situation could change in the country, and then we'll definitely revisit. However, my focus now is improving my liquidity ratios and my capital. If you ask me now, if things stay the same, I will definitely be on the. We're talking about the high single digit growth.
All right. Thank you so much, Nader. Thanks, Abdullah.
Thank you.
Thank you. The next question today comes from Mehmet Sevim from Bloomberg. Please unmute and proceed with your question.
Hi, good afternoon. Thanks very much for your time. It's Mehmet Sevim from JP Morgan. I just had a couple questions, please. One on the margin trajectory from here. I was just wondering how we should think about margins into the last quarter. I assume some easing in funding costs is now reasonable, also taking into account your comments, but I was just wondering if we can please provide some more color on this. And Nader, you mentioned earlier that you expect some easing in funding costs into 2026, and you named obviously several reasons for it. I was wondering also if we can expect an opportunity for lending spreads to improve, maybe coming from better loan repricing, particularly if loan growth slows down, and also obviously on the back of lower interest rates, bringing down the base rate. And my final question would be on the fee income, which is obviously remarkably high, particularly the portion coming from banking services in credit facilities and advisory. I was wondering if you could give us some more color on what's driving this very strong growth, besides obviously just loan growth itself. Thanks very much.
Thank you very much. So obviously, NIM and growing NIMs going forward is a main focus for us here. So to do that, we will be basically focusing on higher value assets. So we will not be on every asset class as we used to. We'll just focus on areas. For example, we'll double down on SME, for example. That's one. Repricing corporate loan is we already started this exercise a few months back, and that should improve our NIM going forward. Cross-sell, which has been a main focus for us, and we created a position here or a department for wholesale. So the corporate and treasury report to the chief wholesale. That actually helped in improving the cross-sell between the product factory, which is the treasury, and the customer department, which is the corporate. And we've seen a really good improvement in cross-sell when it comes to FX, hedging, and other products between corporate and treasury. And we expect to see more of that between SME and treasury. So we expect the growth on the fee income to continue. Thank you.
Thank you, Nader.
Thank you.
Thank you. The next question today comes from Murad Ansari from GTN. Please unmute and proceed with your question.
Hi. Good evening. Thanks for the presentation and the earnings call. I just wanted to get a sense that, with when you talk about loan growth slowing down, I mean, just wanted to get some clarity that, you would expect this to be a sector-wide trend? And when you say that you'll be focused more on specific areas of growth, does that mean that the aspiration of growing in line with the sector above sector isn't really there? It's more about focusing on what profitable areas you can go into. And secondly, on mortgages, you've had a very contained growth on the mortgage book this year versus some of your similar size peers. I was just wondering that, with the central bank increasing the shock limits from 200 to 275 basis points, the fact that, the longer dated mortgage book does create a bigger or result in a bigger interest rate risk on banking book, does that influence your preference for growth on the mortgage side? I understand you're quite well positioned on the interest rate on banking book relative to most of your peers. But is that something that is going to be instrumental in terms of deciding where you want to grow on or how you want to grow on the mortgage book? Thank you.
Thank you. If you allow me, I would start by the first question. I think what we are trying to say here is that with the introduction of the counter-cyclical buffer kicking in May 2026, I think that by itself would create more decelerations on the system when it comes to the credit expansion velocity. So I think that is a natural and it is an expectation that is across the board. So it's a system-wide. I think what we meant here is that the level of the system growth over the past, particularly the past 2 years, 24 and 25, where the credit velocity has superseded on a meaningful way the deposits growth in the system. The gap needs to be narrowed on the back of this capital buffer requirement. So I think that is what we meant into it. I think from our perspective, I think we have been positioning the bank over the past year, particularly when it comes to the capital as well as the anticipations of the impact of this counter-cyclical buffer, including but not limited to the rate shocks going from 200 to 175 basis points. So I think from our perspective, we are very well positioned to navigate and continue our story of progress into the new environment. That's with respect to the overall loan growth. I think the second component when it comes to the second questions related to the mortgages, again, I think it's a continuation or a derivative of the first questions. I think we had been selectively and marginally growing our mortgage book over the past 2-3 years, whereby we complement our portfolio in terms of the not only the mortgage in a simple format, but the type of mortgages that we have been underwriting, as well as the durations that in our book in line with some internal risk metrics. I think mortgage continue to be an asset of strong potentials over the medium and longer term, given that the underlying demographics as well as the actual demand and the future demands generations. But more importantly, I think on a falling rate environment, I think that asset class, we have positioned the bank to capture a meaningful growth over the medium term, whereby we continue to, I would say, preserve or further improve our loan mix. So I think now the mortgages constitute roughly 18.5% of our loan mix. So we do anticipate in a falling rate environment that to be above between 20 to 23, 4%. So I think that what we have been positioning in terms, that's what we have been also, when I mentioned about the diversifications as well as the maturity profile of the liabilities is just to position the bank for the following 8 cycles where we can have a sufficient capacity levels to capture that growth.
Thank you. If I could just have one more question. So the central bank is putting in the counter-cyclical buffer of 100 basis points starting May next year, right? And based on what you've been, and what you anticipate next year is high single-digit kind of growth. So the capital buffers or the counter-cyclical buffer is already kind of, in a way, leading to a slowdown in loan growth ahead of even the buffer actually kicking in actual terms. What would it take for the central bank to go back to a normalized capital ratio? Or, I mean, would we need a couple of years of mid to high single-digit growth for these capital buffers to go back to normal levels? Or how do you see this additional capital requirement evolving beyond, once implemented next year?
I think the main concern for the central bank is the loan was outpacing the deposit in a big margin. So I guess when Sama sees that the deposit growing at a higher pace or the same pace as the loan, probably they will reconsider. But as long as we are seeing the loan growth is doubling or double the size of the deposit growth, I don't think they will change their mind. I don't know if you have anything, Abdullah.
No, I think in general, the counter-cyclical buffer is not something new. I think it has been always part of the financial stability tools that regulators across the globe they tap into, particularly on a continued strong credit growth on the system. So I think we have seen Spain that they have introduced that. We have seen the UAE, they have introduced that, albeit on different levels. But I think given the strong credit growth that has been anchoring in the Kingdom of Saudi Arabia, which is, I think, coming from a huge potential as part of that economic transformation that we are living and progressing through, I think that it's very prudent from a financial stability perspective is that to introduce the counter-cyclical buffer. I think from our perspective, we always and we will continue to manage our capital on a medium to long term basis, and I think this is what we have been doing. I think we will continue to embark on a value creations trajectory. I think the level of growth in terms of velocity measures, we do expect this to decelerate, which is obvious. One is because of the base. Second is also the growth rate needs to go down given the significant growth that has been encountered over the past 24 to 36 months. I think this is very natural, and I think we will continue to seize value creations throughout this journey.
Thank you.
Thank you. Our next question today comes from Olga Veselova from Bank of America. Please unmute and proceed with your question.
Good day. Thank you for taking my questions. I have several. One is on capital management again. Would you consider a reduction in dividend maybe, or potential rights issue, even if not imminently, or this shall be completely ruled out and you would only focus on tier 1, tier 2, slowdown and growth as the main instruments for capital management? So that's number one. Number two is I do hear your willingness to prioritize margins and slow down balance sheet or loan growth into the next year going forward. Year to date, why did you choose to grow balance sheet above the market average despite margin pressure, despite falling CET1 ratio? So what prevented you from using this logic earlier this year? That's question number 2. Question number 3 on Kefala. Maybe I missed, but I do not see Kefala volumes in the presentation. Is this still a priority? What's the share of Kefala in your total SME loans, and what is Riyad Bank market share? Yeah, I think that's 3 of my questions. Thank you.
Thank you, Olga. With respect to the first one, I think, as you know, that we had been always guided by our guiding principles when it comes to dividend, which is basically balancing multiple objectives. One is to have a sufficient level of capital to execute the bank's strategic growth plans. Second is to have also adequate reserves and coverage for our loans portfolio. Third is also to have a total capital where it is operating above our internal risk appetite, while we continue to provide shareholders returns through progressive dividend in general. I think balancing these objectives continue to be intact, and there is no change into that one guiding principles. And I think we will continue to have this guiding our basically future capital decisions. Is the bank in need to do a rights issue in the future to continue? I don't think so. I think the internal capital generations continue to be strong. I think that dividend guiding principles will continue to evolve, and it is an integral part of our capital management and plan, which is an integral part of our business plan for our next strategic horizon. With respect to the second point on the margin, I think the margin contractions are significantly coming from the cost of funds and the changes in the liability mix, as I mentioned. I think we had planned this growth. We have worked and we have updated the investor community over the past 3 quarters that we had been working on building a very healthy and profitable pipelines. I think what we have witnessed is also functions of an increased liquidity premium in the system, while we continue to position the banks for to have sustainable revenue generating streams over the next period. I think what we meant by focusing more in terms of once the capital counter-cyclical buffer comes in, and you need to have a pre-positioning of that, is that you allocate more capital towards higher yielding assets, as well as you continue to derive the non-funded income revenue streams on incremental growth basis. So I don't think it is a significant change in strategy, but I think it's more incorporating the moving parts and operating environments, different priorities, as opposed to a shift. Number 3, when it comes to kafala, I think we remain the leading bank in kafala, although that majority of the growth that took place over the past few quarters have been on non-kafala programs. But I think kafala will continue to have a leading positions. I think we are incrementally growing kafala, where we have a good sights on the quality as well as incremental referrals that we're getting. As we speak, I think we have between 11 to 12 billion of our SMEs portfolio in the form of kafala as of September 2025.
Thank you.
You're welcome.
Thank you. The next question today comes from Shabir Malik from EFG Hermes. Please unmute and proceed with your question.
Hi, thank you very much for the presentation. I have just one question. So you've indicated that there's potentially going to be, or bank's capacity to lend potentially is going to be a bit lower next year versus this year because of the counter-cyclical buffer. How do you expect the project activity in Saudi to be funded then? Do you expect more participation from international banks? Do you expect more debt issuances from some of these sovereigns. So just want to get a sense of how do you see some of those project activity being funded, considering that the bank's capacity to fund them is probably a bit lower next year than this year?
I think all of the above, Malik. I think we've seen the government tapping into the international market. We've seen a huge appetite, and I met many international banks CEOs in the FII, and they all have the appetite to support some of these government projects. So both, I think, tapping into the international market in terms of bonds and sukuk, plus there is a huge appetite from international banks to support these projects.
Great, thank you very much.
Thank you.
Thank you. The next question comes from Abdallah Al-Araidi from Emirates NBD. Please unmute and proceed with your question.
Am I audible?
You are.
Hello, can you hear me?
Yes.
Yeah. Okay. Thank you very much. We've been hearing some rumors that is coming from allegedly from some officials that there might be some regulation on the simple LDR. Is this something that you're hearing about? And if so, we're noticing your simple LDR is one of the highest. So how could you counter such if this happened? And moreover, we're noticing in this quarter some decent write-off, 1.4 billion. So if you could allude it on what are the sectors, or if it's a specific account, or where is it coming from? And yeah, that's it. Thank you very much.
Thank you. I think I'm not aware of this rumor, and I don't think we have been always reacting to rumors. I think let me tell you how we are monitoring and managing our liquidity and funding. We do have the regulatory LDR. We do have also the simple LDR, because also we do have a funding and the balance sheet on a simple format. So the cash flow and 30 days maximum cash flow outflow, etc., and the LCR, of course. And we do have also the unweighted LDR, which we monitor on a daily basis. So these continue to be, and along with the SAMA liquidity ratios, which is part of the regulatory and prudential returns that we do have a periodical reporting basis with SAMA. So these are the key components on the liquidity management basis that we are managing the liquidity. And based on that, we set our internal limits. Based on that, internal limits have an adequate buffers over and above our risk acceptance criteria, or the RAS, if you like. And that's how we have been managing this. So we are not aware, and we haven't got any sort of communications on that one. With respect to your second question, I think if you recall that Q4 last year, we have indicated that we had been working with one exposures on trying to restructure that exposure and to make it a more of an acceptable structure for the bank. While at the same time helping the customers to navigate its difficult times. I think that structuring efforts has continued for a few months, and then it has collapsed by end of Q1, and that account has been completely shifted to an unperforming account. And since then, there has been no absolute development or cooperations. In reality, there has been some legal escalations from the bank, and that has ended into a very long legal process. So the bank has covered that exposure in the past very properly, and the bank, given what happened during the course of the second quarter, as well as the advices that we're getting from our legal team internally, as well as through the subject matter experts that we are using in that case, we see that the recoverability of that account will take years to have a meaningful recovery. So the bank has decided to write off that exposure, given that it is already provided for. So simply that has contributed to the NPL ratios improvement, as well as partially has increased our coverage ratio for that NPL. And that has been an isolated case. It has been there for a while. We tried our best to make it work, to support the customers, but I think all the forces have worked against it.
Thank you. In the interest of time, that is the end of the Q&A session. So I'll now hand back over to Nadir Al-Khairiyah, CEO, for closing remarks.
Thank you very much. Ladies and gentlemen, thank you for joining us in today's call. We are pleased to have shared another set of strong and healthy results for the third quarter of 2025. Our continued progress reflects the strength of our strategy and the discipline of our execution.